The epicenter of a catastrophic financial crisis is supposed to follow a predictable sequence. Capital flees the collapsing system. The sovereign currency collapses. Following the 2008 meltdown, and again during the 2011 debt ceiling standoff, international political economy models pointed to a rapid global sell-off of U.S. Treasury bonds. The logic was standard. When a nation's financial sector detonates, global markets stop lending that nation money. The opposite happened. Instead of fleeing, global capital flooded into the United States. Foreign investors bought so much U.S. debt that federal borrowing rates dropped to near-record lows. This chart shows the dual forces at play. The line falling toward -6% of GDP tracks the U.S. current account balance, the domestic sector running massive deficits. But look at the opposing trend. The second line represents the rest of the world's share of U.S. public debt, climbing steadily to nearly 50%. Through the entirety of the post-2008 recovery, a period defined by massive quantitative easing, banking collapses, and severe political dysfunction in Washington, that 50% foreign ownership threshold held incredibly stable. The standard professional explanation for this stability is known as TINA. There is no alternative. Investors buy U.S. debt, the argument goes, simply because the Eurozone has its own sovereign crises and Chinese bond markets remain closed off. That framework is incomplete. A lack of alternatives dictates where money must park in the short term. It does not explain why foreign investors genuinely trust the United States government to repay its obligations over decades without quietly inflating the debt away. The ongoing resilience of the U.S. Treasury market relies on an active symbiosis. It is anchored directly by the American domestic political economy. The actual mechanism enforcing U.S. fiscal credibility is the structural power held by the wealthiest 1% of American households. The 2008 meltdown was a status quo crisis. It was a systemic shock that bypassed the destruction of dollar hegemony entirely and instead reinforced a mutually beneficial loop between foreign capital and the domestic financial elite. A truly dominant global currency performs three strict roles. First, a unit of account. Second, a medium of exchange. And third, a store of value. The US dollar is experiencing a massive divergence. As a medium of exchange for international transactions, the dollar is actually gaining strength. This chart maps currency payment shares. The dark blue bars show the US dollar climbing from 32. That transaction dominance is locked in by the dollar's unparalleled depth in global foreign exchange markets. On a purely transactional level, global de-dollarization is a myth. The dollar's medium of exchange utility is expanding at the direct expense of its historical rivals. The euro area and China represent a combined GDP of around $35 trillion. With that sheer economic weight, why can't their currencies rival the dollar's transactional depth? The euro has a severe structural flaw, a monetary union without fiscal integration. A single central bank manages fragmented sovereign states. Without a unified bond market, liquidity is destroyed. Meanwhile, the Chinese renminbi faces strict capital controls, trapping massive pools of capital behind state oversight. Beijing maintains these capital controls because state interventions prioritize domestic financial stability over global currency integration. For institutional investors managing global reserves, extensive state control and the absence of a transparent institutional framework create heavy political and governance risks. China is steadily expanding the use of local currency swap lines and its cross-border payment system, but routing mechanisms aren't markets. They don't create the freely floating capital markets necessary to anchor a global reserve. The euro is structurally too fragmented, and the renminbi is politically too controlled. Global capital remains trapped in the dollar system, out of structural necessity, but the dollar's transactional strength masks a distinct vulnerability. Its credibility as a store of value is declining. Global central banks are diversifying their reserves away from US dollar-denominated assets. This shift sharply accelerated after the geopolitical weaponization of the dollar in 2022. Before 2022, central banks bought about 500 tons of gold annually. Since then, that number has doubled to over 1,000 tons per year. This creates a tension in the data. If central banks are hedging with gold and the U.S. public debt is breaching historic highs, why do foreign investors still hold 50% of that debt without demanding massive risk premiums? Economist Eswar Prasad proposed a widely cited theory. Foreign capital trusts the U.S. because older American voters hold vast pension wealth in treasuries, acting as a domestic veto player to enforce fiscal discipline. The demographic assumption relies on age. Seniors vote in high numbers. If politicians attempt to inflate away the debt, senior citizens will vote them out of office. Empirical data from the field of gerontology dismantles this assumption entirely. Senior citizens are deeply fractured on ideological lines. They don't vote as a cohesive economic bloc. The true locus of domestic power protecting the public debt is class concentration, not age demographics. This chart compares public debt ownership concentration. The top 1% of U.S. households owns 33% of the debt, translating to $1.15 million per capita. By contrast, the 60-plus demographic collectively owns 53%, but per capita, they hold only $57,000. It is not the democratic mass of elderly voters that protects the dollar's value. That stability is enforced by the extreme, concentrated wealth of the financial elite. This enforcement relies on what political economists call structural power. The top 1% doesn't need to explicitly lobby the government to protect their bonds. Their concentrated wealth is a latent threat to stability, forcing the government to respect business confidence. This structural power creates an ideological climate in Washington that reliably prioritizes the interests of bondholders over the concerns of the general citizenry. This domestic power structure operates in a symbiotic feedback loop with foreign reserves. Export-heavy nations recycle trade surpluses into U.S. treasuries, lowering U.S. borrowing costs. This cheap sovereign borrowing allows the government to deficit spend without raising progressive taxes on the wealthy. By financing deficits through foreign debt rather than domestic taxation, the system neutralizes the political urgency for aggressive wealth redistribution. Simultaneously, this flood of foreign capital lowers consumer interest rates, triggering a massive expansion of household credit. Access to cheap credit acts as a political compensatory mechanism.